Welcome to Financial Revelations. I am David Safransky, your host, and I'm being brought to you today by three-piece suits. Yes, I have a three-piece suit on, purple shirt, purple tie. Usually I go for a little bit more contrast, but it just felt right today, and so that's what I wore. I usually wear suits. It's easy to wear for a guy to wear suits in the winter because it's like garanimals. Everything goes together. It's like your mom picking out clothes and laying them out on the bed for you, so suits are really easy. You can always reach us at 1-800-344-2534, 1-800-344-2534. You can email Corey at epsf.com. Of course, that's going to be scrolling underneath of me. And we're on Twitter. I haven't posted a lot on Twitter recently, but I love what's going on with Twitter. I really like what Elon Musk has done, putting out these the files that show just how much the government was trying to quiet the conversation about COVID, about other things. They were even going after people who were telling jokes, where government officials were emailing and talking to Twitter executives about shadow banning or banning those accounts outright. And I like this because in a democracy where free speech is at a premium, hate speech is actually protected speech under our Constitution. Now, I don't like it. You don't have to like it, but until you're willing to defend the very speech that you hate the most, you don't really understand free speech. And free speech is very important in America, and we've got to have it. And one of the things about COVID that really upset me the most was how much power that politicians got and are unwilling to cede that power back to the people. So we've got to be really careful. I think if you remember back 9/11, one of the things about 9/11 that I remember saying was, well, the Patriot Act is fine with me because I'm not a terrorist. But then the Patriot Act got abused, and I think we have to really make sure that we're checking the power that government officials have, because the people that want it at first might not abuse it, although I think they did in COVID. It's the people that come after them. And the Patriot Act probably has stopped terrorism. Yes, that's true. But it's also done a lot of other things to invade privacy of people, and that I'm against. So on Twitter, it's at SkiBucks1, the number 1. That'll also be on the scroller. So if you have questions, if you have comments, if you have concerns about anything financial, I want you to reach out to us because we'll answer that on the podcast. So one of the things that I'm getting questions about right now is, of course, about the Fed, because the Federal Reserve is still raising interest rates and what that does to the market, and how I think the next Fed rate hike is going to affect us, because that's next week. The Fed has a meeting January 31st, February 1st, and they take off the rest of February and come back in March. And I think that they're going to go 50 basis points or 0.5% in January. And I think that they have a couple more rate hikes in them. But what the thing is about the market that we're in is that even though the Fed is in it, I think we're in what's called a secular bull market. And secular bull markets tend to last generally about 20 years, where you have a lot of innovation. It doesn't need to be technology, because there's been other secular bull markets in the past. And it was the technology of the time, whatever that technology of the time is. And of course, today, the technology of the time started out with smartphones in 2008. The Apple iPhone came out in 2008. And this secular bull market really started in March of 2009. I was just looking at the markets last night over the course of time, doing some charting and whatnot. And you could see it's about March 9th was the low in the markets. They called that the Haynes bottom, because there was a commentator on television who said he really felt like this was the bottom of the market. And I'm pretty sure that was March 9th. And lo and behold, he was right. And coming out of 2008, if you own good stuff, and, when I mean good stuff, I mean stuff that's still around today. There's some companies that aren't around, big companies that aren't around today, that were there in 2008. But if you own the good stuff, odds are that you were probably back in the green at the end of 2009. The market did come back relatively quickly. One of the things that I think the government learned in 2009 that they did not repeat during the pandemic was you can't wait to throw the kitchen sink at things, because if you wait too long, you need an even bigger kitchen sink. And so one thing that I did appreciate that the government did in the COVID, especially at the beginning when we didn't know what was going on, for the first 3 months of COVID, we didn't know. And so I could give politicians the first 3 months. It's after that that I take issue with the power grab that happened. And if you look at some other Western democracies like Canada and Australia, what they did there is shocking. And if you're not shocked by it, then I don't know what to tell you. Check your pulse. But secular bull markets usually last around 20 years. This began in March of 2009, and it was really only interrupted by the Greece and Spain kind of debt debacles, COVID, inflation, and the Fed. After the Greece and Spain got decided, which they didn't really decide anything, they just extended the debt, the market took off again. After we realized, okay, the whole population isn't going to die from COVID, the market took off again. And once the Fed and inflation kind of gets under control to some extent, and I think that's going to be the Fed stopping, I think the market's going to pick up and take off again. And so I think that we have maybe, let's see, it's 2023. I think we got 5-6 years left of this secular bull market before we go into a real extended downturn. But there's no guarantee that will even happen, because we could create other markets that don't exist today. So I think it will pick up again when the Fed does their 3 more rate hikes. And I think they got 50 basis points in this meeting next week, and then 25 basis points in March, and 25 basis points in April, and then I think they stop. I could be wrong. It could be 25 basis points this month, but I think it's going to be 50, because they've been talking a really tough game. And what they've been doing is every time the stock market catches a bid, starts to go up, a Fed governor comes out and talks about that they might go to 6%. And I think they're talking a tough game, a little tougher than what they're actually going to walk out. And I think you're going to need the GDP to slow down a little bit. We had a good GDP number out today. Good news is not great news right now. You'd rather see a little bit of bad news, because that means the Fed is closer to stopping. But I do think you're going to see unemployment start to rise. We have some big layoffs. Microsoft, big companies doing layoffs right now. Google just did a 12,000 person layoff. So these are big numbers, and it's going to have an effect. And the stock market really looks ahead. So the stock market isn't necessarily thinking about right now. They're what you call a future discounting mechanism. And so if profits are up, prices will go up. If profits are down, prices will come down. And right now, what the Fed did by raising interest rates is they kind of put a damper on some profits, especially if you're a highly levered company where you've got to pay money. You're paying out profit on these increases in interest rates because you're borrowing a lot of money. So if the cost of money goes up, your profits go down, and we'll talk about that in a second. So I think the Fed reset rate, where what are they trying to reset? They're trying to reset housing. Housing is kind of expensive, especially if you go to the left or the right coast. It's very expensive. There's cities in America like Austin where housing has gone up 20% a year. I think they want to dampen that a little bit. They're going to reset those prices somewhat. They want to reset tech stocks. So these highly levered companies that borrow money to keep operations going, they want to reset those lower. They've already reset crypto. They've already reset the NFT market. Remember NFTs? Yeah. I'm old enough to remember when those were popular 1 year ago. They're not anymore. They want to reset the car market. Anything with an interest rate attached, the Fed really wants to do a little bit of a reset and bring it down. Well, you can check the box on the stock market because they've already reset that. That was last year. And the market's doing pretty good this year so far. Now it's early, but I think their reset rate is somewhere between 5.25 to 5.50. We're at 4 right now. We could get to 5 and they stop. I'm thinking 5.25, somewhere around there. And even if they stop, that doesn't mean they can't come back and raise again. They could. If the data gets worse, they will come back and raise again. They're not going to lose this battle. And they're kind of in a tug of war right now. The Fed is in a tug of war with the federal government, the administration, and Congress, because the administration wants to spend a lot of money. They want no budget cuts. Well, the Fed is going to make it really tough on them. And if they keep spending money, we've crossed $31 trillion in debt. That's a lot. It's over 100% of our GDP in debt. Well, unsustainable probably. So it would be good to do a little bit of cutting. Maybe even if you just froze budgets would be a good place to start. But then after this reset rate is there for a little bit and the market slows down and we might even go into a recession, the Fed is going to move back to their terminal rate. And the terminal rate is a term that they use for where they want to keep rates long term. And I think that's more like 4.25 to 4.75. So you're looking at quite possibly a full percentage point rate cuts. And how they would do that would be 25 at a time. So let's say we get to 5.25 or 5. Then they're going to leave them there for a little while. And then once they see the market slowing down, they'll come back to us and they'll say, we're going to cut a quarter point. And the market will love it. Now, there's been some really bad markets after the first rate cut. And the reason is the market then says, is something else wrong that we're not seeing? So the first rate cut isn't always a magic bullet, but the next couple would be. And what they're doing then is they're making money cheaper, trying to restart the economy. So that's what I see happening. That puts the 30-year mortgage, if their terminal rate is 4.25 to 4.75, somewhere around 6 to 6.25. I'm also old enough to remember when mortgage rates were at 2.65, also about a year ago. Just to give you an idea of how fast the Fed has moved, it's incredibly fast. They did 4 75 basis point rate hikes in a row. They've never done that before. And remember, the stock market is what we call a future discounting mechanism. So as prices are coming down, profits are going up, and that means stock prices will go up. The way the stock market works is by the time the general public figures out that things are better, they're already better in the stock market. So you've missed that big return trip. That could be 10, 15, 20% in the market. So the calls that I get the most are when people will call me and say, hey, that was going so good. Why did you sell it? Well, because we want to buy low and sell high. So we'll trim positions. It's actually rare for us to take a position totally out of portfolios. Now, we do it. The one example would be Bed Bath and Beyond. Bed Bath and Beyond. Yeah, I always get that mixed up with Bed Bath and Body Works. But I know the symbols. I think in symbols. You guys think in names. So Bed Bath & Beyond was taken over by a private equity firm. I knew the firm. I'm aware of them and some of the other things that they did. And I thought this is a good fit for them. We bought the stock. It was paying a healthy dividend. And it went from like $12 to $75 in a period of months. That stock came out because it had done what I asked it to do. It made us a lot of money, made our clients a lot of money. And I didn't think it could stay there. And lo and behold, I was right. They filed for bankruptcy, so we got out when the getting was good. So I get that call out. Why did you sell it? It was going good. The other call that I get is, why are you buying that? That stock stinks right now. I'll give you another example, Boeing. Boeing had a lot of trouble. They had trouble with the 737 MAX. A couple of them crashed. A lot of people died. And that's tragic, of course. And it didn't look like they had a good handle on what was going on. And so that stock just got pummeled, hammered. In the pandemic, it was in the 90s. This is a $400 stock in the 90s. They're really only one of two major plane manufacturers in the world. Good stocks, great stocks on really bad news are compelling to me. So I bought that stuff, and that's paying off nicely. Now, it may work for your portfolio. It may not. Whenever I mention an individual name here, I'm not recommending that you buy it. I'm recommending that you look at it, consider it, and talk to a financial professional about whether it would be right for you. It may not be. There are some people that I would not buy Boeing or Bed Bath & Beyond for. It's just not in their best interest. And that's what, as a registered investment advisor, I'm a fiduciary, and I have to act in your best interest at all times. Not my best interest, your best interest. And that means sometimes telling people, no, I'm not going to do that. And believe it or not, I get into, not fights, but we get into heated discussions. My wife and I don't argue. We get into heated discussions. Heated fellowship, we call it. Somebody wants me to do something. I'm the financial professional. And if it comes right down to it, I'll even say, look, you could do that. I have no problem with it. You're just not going to do it here. And that's how strongly I feel about acting in your best interest. So don't get too enthralled with what the Fed is doing, because I do think that they're going to lead us to a place and then they're going to come back to us. So if they come out and they talk tough next week, I think we're pretty close to the end of the interest rate cycle. And what it has done is it has made my job a little bit easier, because now the bond market is back in vogue and we can buy bonds again. And that is, for the right people, that's what we're doing. The right kind of bonds for the right people at the right time. And you want to buy bonds, we talked about this last week a little bit, you want to buy bonds essentially at the top of the interest rate cycle if you can time that. And it's a little bit like hand grenades and horseshoes. You don't have to get exactly at the top, but the closer the better. Again, talk to a financial professional. I'm not recommending that you go out and buy bonds right now because I don't know you. And one of the things about our practice, and really anybody who does this that is a professional, we're professionals here, we need to know about you. So before I'll invest for somebody, we got to have essentially your personal financial statement. There's paperwork that you fill out. I ask questions. We have a fact finder that we go through. And if you come to us and say, hey, I've got $50,000 in credit card debt, but I'd like to give you this $50,000 from my savings account to invest, I'm going to say no. I can't do that. Pay off your credit card debt. And so there's a little bit of a science to this. We want to make good decisions for you. We want to help you to be wise financially long term. So I like a holistic approach to it, where I don't just look at your investable assets. I look at everything. And we need to see everything, and that's what we're going to do. And if people don't want to give me that information, then I'm not their guy. It's just that simple. So, excuse me, Fed next week. We'll have a podcast after that. We'll have a lot more information to give you, and we're looking forward to see. I am David Safransky, your host of Financial Revelations, a real American, and the voice you can trust.